Hello, hello.
Good morning, Vietnam, and
Good morning,
Cambodia, and the United States, and Italy, and France, and everywhere
everywhere
else.
else. Yes, absolutely. So, Pankaj, how you doing, man?
I'm good. I'm good, man. I think it's been about 2 weeks since we did our last stream, or 10% on the Dow. Depends on how you want to quantify the amount of time.
Yeah.
Um, I think things are getting serious with this whole Corona thing. I actually canceled my vacation last week to Orlando and
Wow.
Disney because of this whole Corona thing, and it looks like it's going to get a lot worse before it gets any better.
It's hard to imagine any other pathway than that, right?
Well, yeah. I mean, I think people were kind of hoping that China moved fast enough to contain it. And I think there was a lot of criticism for how they were containing it. There was criticism against the U.S. administration for stopping all travel to China and all that. I think in hindsight, everyone's like, well, that's probably a good idea that both
Yeah,
these governments did all this, but it still wasn't enough.
absolutely.
It's also scary because we just don't know enough about this disease and this virus, and I think that's really what's scary. Is like we're kind of figuring it out as we go. Unfortunately, it involves people's lives,
Yeah.
and it's something that is so easily communicable that and because of the long incubation period, you don't even know if you're sick, right? And that's the scary part.
Yeah.
So it's a little frightening. I think just if we focus purely on the economic aspect of this impact, I think everyone's starting to finally get a handle on what this economic impact is going to mean. And unfortunately, I think there's still a ways to go for people to really understand what this impact is going to be. And I don't mean that people are still optimistic. I think all optimism has gone out the window. I think it's more of really understanding what impact it's happening or it's having on the whole supply chain of the global economy. At least what I've thought in the past and what I've finally gotten confirmation of is that there's just there's too much of an over reliance on China for manufacturing of everything, right? And that I think that's something that a lot of companies are now going to have to come to terms with and figure out. Okay, well, how do they diversify their manufacturing risk, right? Their supply chain risk, and where do they do that? So I think there's a lot of lessons to be learned from this whole thing. Unfortunately, it's a lot of lives that are going to impact everyone. But hopefully the CDC and some of the WHO and some of these other organizations are able to find better treatment methods and minimize the impact to people. And hopefully we'll find a cure in some time. But I think the impact on the venture industry still hasn't been felt yet, and I think that's something that's yet to come. With the stock market globally just falling so much in such a short period of time, I think what's going to happen is the IPO windows are going to start closing, and some of the IPOs that were planned for this year might be put on hold kind of indefinitely, which is also going to mean that eventually it's going to trickle down to various stages of venture, and people are going to start either writing fewer checks or writing smaller checks or pushing valuations down. It's going to have some sort of impact. We don't necessarily know what impact yet, though.
Yeah. The intersection of how much economics and health are attached is actually, I think it's a thing that a lot of people don't appreciate, and you don't notice until something like this happens. And then when you start to think about the trickle down of all of the places and all the things they're doing, it becomes very apparent how big of a deal it is.
Yeah, absolutely. I agree. It's there's a lot that we're all learning as we go, right? And the health impact, I think people kind of know, like the healthier you are, at least on an individual basis, the more you can actually get done, and the less healthy you are, the less you actually get done, and your ability to earn and everything's directly linked to that. But now we're seeing it at such a macro scale that it's a little humbling.
Yeah, absolutely. Well, on that note, let's get into some financials here. So, I want to give folks a few minutes to join us as well. But welcome to The Raise. In case this is your first time, we are a real-time interactive series on how to raise money. This is not really a workshop or a seminar. It's really a behind-the-scenes look at the research, the decisions, and the actions that I've been taking in the process of currently raising money for my next startup, Fanbase. And we hope that by letting you see behind the scenes and sort of experiencing what's actually happening to me, that you get to learn and understand the process itself, be able to follow along at home, and maybe adapt or borrow some of these techniques for your own efforts.
Yeah, and I'm kind of playing the role of the angel investor VC in this series, helping Greg through the process, asking the questions that a VC might ask, but also sharing some of what's going on in the mind of a VC or an angel investor during this whole process. And most importantly, we want to know what you guys think, what some of your questions are, and try to answer them through the process, through Greg's lens of raising money. Feel free to ask any of your questions on foundercraft.com. There's a question section over there, and you can also email us at raise@foundercraft.com. And so we look forward to your questions. And if you got questions you're watching live right now, feel free to ask in the comment section, and we will try to answer them as we're doing this live stream. Greg, let's jump right into the financials. I know this is a topic that is extremely cryptic for a lot of founders, and I know a lot of founders struggle with this, especially first-time founders or first-time founders that are raising money. There's a lot of information out there, but I think that's part of the confusion. There's a lot of information out there, right? And what information do you pay attention to? What matters? And let's try to unpack some of that now for our folks.
Yeah, absolutely. So let me upfront sort of say, like, probably most importantly, I am not a finance person in any way, stretch or matter. So this experience has been new for me, for sure.
Yeah.
And, in the description or the abstract I sort of wrote for this episode, what I pointed out was that, one of the challenges with this kind of with this effort is that in telling the story about your economics of your business, you're really giving a different point or a different way of telling the same story about the opportunity that you see, right? And so there is sort of this narrative-based version, which is very qualitative and about the story and about the emotional part and the attachment and the pain points that people feel. And then there's this secondary point of view or this qualitative look at the business, which is sort of tied to your metrics, your revenue, your growth, and how you expect to or experience things going forward, right? And I think it's important to realize that you do have to get this part done, but how done is sort of an interesting question, I think, that is left open to analysis. And I think it's going to be highly dependent on the stage that you're raising at. And so actually at Pankaj, I'd love you to comment a little bit, I guess, on the weight of the financials, sort of maybe like starting in that pre-seed, sort of moving, because that is a question. What are the overarching sort of challenges or mental pressures that you feel when you're putting them together, especially as a business, like with your product barely out the door, with no financials to back on or no data to back on? It feels a lot like fantasy, right? Like making up things and just pretending things are going to go in a certain way. And so that's a little jarring, right? Because it relies on none of my normal intuitions, right? Like as a product person or as an entrepreneur.
Yep.
So I'm curious, like how you see the weighting of the financials sort of over time.
Yeah. So, all right, let's start from stage. If you're a pre-seed company, uh, in many cases, you probably haven't even incorporated the business yet. You might be planning to incorporate the business soon, or you've just incorporated the business a couple of months ago. So there's not a lot of financial history because there's probably not a lot of money in the bank account. Maybe some of the founders came together and put a little bit of money in early on to kind of fund getting your AWS up, your web hosting, blah blah blah. So maybe there's a little bit of money in the account. There's not a lot of business transactions happening, so there's not a lot of revenue coming in and out. So financials are pretty simple. They're not going to really tell you a whole lot, right? And I'm talking about actual financials. I'm not talking about projections. But what a lot of investors want to see is projections, right? Now, this is a very subjective thing. Different investors have different perspectives on this. So it's important to know who you're pitching and what's important to them, right? Sort of like what we talked about in the earlier episodes about researching the investors that you're going to be pitching and what do they care about and what do they look at. But generally speaking, I think for really early stage companies, pre-seed and seed stage companies, most people understand that a lot of the financials that you are modeling out are really theoretical. They're not practical. You don't know how much revenue necessarily is going to come in. You don't know how many customers you're going to have. You don't know what your closing rates are. You don't know your payment schedules. Are people paying you in 60 days? Are you paying me immediately? You just don't have enough of that information, right? So you're going to make a lot of assumptions. And I think where a lot of founders get stuck is, what assumptions do I even make, right? And that's very subjective to your business, but there are general rules that you can apply to like what assumptions make sense, right? Like if you are starting out and you're talking about, let's just talk about a B2C company. If you are acquiring users through primarily through Facebook ads, Google AdWords, perhaps some social media marketing, you can estimate what industry conversion numbers are, right? So you can say, well, if we're spending X amount of money on Y number of ads, we should have a Z percentage of people that are converting, right? And you have to do some research to find out what is kind of an industry average for that you could use. But that's a good place to start. Say, okay, if the industry average is a 2% conversion rate from the top of the funnel all the way through, well, there's no reason for you to use 5%, right? Be conservative and use that industry standard or industry average and model out based upon that, right? There are also other assumptions you can make and say, all right, well, none of the founders are going to be paid market salaries or salaries until you raise a certain amount of money. So you could say, okay, people that we hire, we're going to give some equity to or options to. So, they're probably not going to take full salaries, but we know what the cost of an engineer in the Bay Area, New York, Bangalore, Singapore, we know what those general numbers are for certain people with a certain amount of experience in a specific domain expertise. So let me take that average and say, okay, this is what I think our salary expenses are. From my perspective, I think expense projections are more important than revenue projections because expense projections are, they could actually be real and they could actually provide a roadmap based on your product roadmap, sales roadmap, everything else of where you want to go and how much money you're going to need to do those things, right? Now you could be off, right? You might allocate like, hey, I need 6 engineers and I need $1 million over the course of 18 months to pay for those engineers at $150,000 a piece. But you realize you're getting engineers for $100K because you're getting them in, Kansas City or something, and they're cheaper than they are in the Bay Area. So you're saving, a lot of money on that, and you could use that to hire an additional salesperson. You're still using that full $1 million, but you're just using it slightly differently, right? So those are certain things that you can do, and you should start with making those assumptions and really outlining them and asking somebody to actually give you a sanity check and just say, am I really off? Is this reasonable? It doesn't have to be 100% accurate, but is it 70% accurate, right? Is it more than 70% accurate, or is it less than 70% accurate? If you're 50% accurate, you need to continue working on it, right? If you're 70% accurate, it's a good place to start. And if an investor asks you for financial projections, you have something. Now, how long those projections should be for? Well, again, it depends investor to investor. I think a lot of investors have this habit of asking for 2 years of financial projections. I think anything beyond 6 months on the revenue side is just guesswork and an exercise in how do I use Excel. But if you are doing expense projections, I think the expense projections should map pretty closely to your product roadmap and your business roadmap, right? And based on that, you should be able to figure out what your business is going to need in terms of capital for that amount of time. I say you're doing the exercise, might as well do it for 2 years and have it ready. So when somebody asks for 2 years of projections, you can send it out to them. I've seen this. I think it's ridiculous. Some investors have asked for 5 years of projections. Now it's a matter of just extending that Excel spreadsheet and just copying and pasting the formulas out to 5 years. But I don't think that really does anybody any good. And my argument to other investors who ask for 5 years of financials from a early stage company is like, why? Do you think this business that they're starting today is going to be the same exact business, be run on the same exact assumptions that they're making today in even 3 years? No, it's not. It's going to be very different in a year. So, I think 1 to 2 years is fine just to get an idea. And what's important is I think investors really want to see, all right, you as the founders, how much time and effort have you put into thinking about putting all these pieces together and saying, okay, this is my product roadmap, this is my business roadmap, this is how much I want to do in sales, these are the targets that I'm setting, because all these pieces fit together, right? They're all part of that same puzzle. And put that into a model that says, okay, I think I'm going to sell the product for this price. This is how many customers I think are going to convert based on industry averages. This is how much money I need to spend on sales, marketing, BD to bring in people into my funnel. And so what's the financials really what they do is just give us some idea of how you as the entrepreneur have thought about all of these things and how you piece that puzzle together, right? So it's another piece in the due diligence pie, not for the financial sake necessarily, but more for like what's going on in your head, right? And how you're good at organizing that and structuring that into something that's actionable.
I get that, and it's interesting because I think part of my experience is, or that was my anticipation, right? Sort of like, so the first draft I made was I actually didn't model revenues, right? Like, because I was basically like, I have my expenses. It's probably the only part that you really need to know about is for the next year or 2 years, how am I going to spend this money? Right. And then when we did get asked for financials, they wanted some revenue projection. So then I went back and tried and layered some stuff in, which I think is reasonable. Like, if we're making a claim, we're going to get to break even. We have to show how we're going to do that. Right.
Yeah, absolutely.
So I think like that's an important signal that if you're going to put out like that this money is going to do something for you, you got to back up whatever the something is, right?
Yeah, absolutely.
So if it's just 2 years of runway, then really you're saying I'm just going to spend this carefully over the next 2 years, right? But I would argue that more importantly, as an investor, you likely care about this. And as a founder, you should absolutely care about this, is if you are getting on the pathway of raising money, you have to create the next milestone, right?
Yep.
And so you do need to back into sort of like, well, yeah, sure, I can give you enough money to give you 2 years of runway. And then what? How will you raise money, right? Like what will you have achieved with that, right? What outcomes are we going to produce, right? And so, and if you're getting a 2 years of runway in your pre-seed, you likely should have to produce revenue. I would say for most software startups, I would expect that you would produce some revenue. A hardware company or some other things, maybe not, right?
Right.
E-commerce company, absolutely, you better produce some revenue, right? But I think you got to figure out that part. So I would say I think it's greater than just expenses. But for me, it feels like the thing to think about is how do you create the next funding event, or how do you eliminate the need for a next funding event with this round of money, right? So maybe you don't want to raise money again. That could be a thing, right?
Yeah.
But then you have to show that you're not going to need more, right? Later, right? And you're probably wrong, right? But it's okay, right? To have that aspiration, I guess, right?
Yep.
If not, that whatever you're raising for now, figure 6 months back from the end of that money running out, you've got to start raising again. And so the real question is, what's the story you plan to be telling at that window when it opens?
Yeah. No, all fair points. All fair points. I think you're right. The story that you're telling should lead to two potential outcomes. One is, as you said, how do you get to the next round of financing? Should you need it, or how do you get to becoming a self-sustainable business, if that's the path you choose to go forward with? And every investor is going to care about both, especially at the early stage. They're going to want to know, hey, is this amount of money going to get you to that next major milestone, right? Whatever that is.
Yeah.
Is that going to be a significant amount of revenue? And you may or may not raise any more money. If you decide to raise money, it's really going to be to just slam on the accelerator, or are you going to need to raise money because you've gotten to a milestone, but you still haven't really gotten to, let's say, a major inflection point in the business where it's self-sustainable. So you're going to need some more money to get you there. So you're not at the growth stage yet. But people want to see, hey, is this money going to get you to one of those major intersections where you could say, okay, we've got some product market fit, we believe, and we could either focus on revenue, or we've got enough product fit to raise a significant amount of money to really take the business to the next stage, right? Look, everyone knows that none of these answers are easy answers, and they're also not answers that you're expected to have. But I think what everyone wants to see is that you've thought about the path to get to some of these answers, and you've articulated that in the story that you're telling. You've articulated that in the projections and financials and plans that you've put together, right?
Yeah, without a doubt. So for what we plan to do is we've got a template that I use to sort of put together some of my stuff.
Yep.
And it was one we found online that I think was pretty effective. And I'm going to try to zoom in here a bit. But what I was thinking is it may be useful to just go through some of the kinds of things that are in here that are maybe people need to think about. And so there's a number of different things. And let me provide some feedback on this template. I used this template and sent it to an investor who asked for diligence, and I'm pretty sure it didn't help me using this template.
Okay.
And I'll tell you why.
Yeah.
This template is fairly robust. And maybe the expectation was, because we were so early, that it would be one sheet with some scribbles of numbers, right?
Yeah.
I don't know what, I guess what I'm saying is it didn't feel like I walked away better off, right? I felt like they looked at a lot of things. It confused them on different points. that worked against me, I think, right? Like, so I had to like do a lot of cleanup after the fact. So here's what I would recommend is just from experience now. If someone asks you for something, I would ask if they have a template for how they'd like to receive it.
Okay.
And
that's fine. That's fine. But before you continue any further, what I'll ask you is like, hey, what if you're talking with 5 different investors and they all have different templates? Are you going to put together financials 5 different times in their format, in their templates?
No, that's not what I'm suggesting. I guess, but for the first time, it still feels better to start closer to something that a real investor is looking at than maybe something you may like find on the internet, that's not from an investor, right? Like, so that's my only caution, right? Is just that is that you're likely closer to the acceptable level of fidelity by getting it from someone who does a lot of deals in your space, right? Like, and like someone who may help you lead, like can use those to like talk to other people about it more readily, et cetera. So I would say like, if your lead has a template or potentially considering as a lead and they offer it, like that'd be a great place to start because you want them the most comfortable, right? If it's just your first convo and they ask for it, if they have examples of what they like, either way, even if you don't use it, it still feels like it would be useful and informative for you to understand what they're kind of looking for, right?
Right. Yep.
So I just want people to know, like, I took this off the internet and I think it was good for me. It wasn't good, like in getting it out into the world, and doing it. Now I'll show you, for example, this template has a number of sheets. In it, one of them is like this sheet with all the salaries. And so, this thing may be designed for people later in their life, but because it listed, for example, all of these potential like job titles and salaries and all these other things, you look like an idiot if you send this out because like someone could easily think these are all the people you think you're hiring. This is what you think you're paying them. Right. And so like these things can harm you, I guess is my point. Right. Like one, because like it could become a lot of work to have to go deal with updating all these numbers to make everything seem realistic and normal. Right. Or because if someone misunderstands what you're showing them, they may think you're doing all these things on top of it. Right. So let's go to the 2 that I think are the most important from my book. One would be the SG&A. So this is really like all of or maybe we should go to COGS first. Let's start with COGS. So this is like basically what it costs you to run your business, right? In this sheet, right? And so it's really just figuring out like, hey, what are all the services you're going to be paying for? And how much do you expect them to cost and how much do you expect them to grow over time? Right. And since like most software startups these days are just running, on Amazon or, some kind of other virtualized platform, this scales somewhat readily and somewhat easily. I found this not difficult to estimate from my experience. Now the question here I would have for you is how much fidelity should be here, right? Is every little tool I think should I list them all out, right? Or is just like your big primary bucket ones like kind of enough?
So I think your big primary bucket ones are enough, but then you should also just say, look, I don't know if I need Dropbox right now, right? Because we're all getting Microsoft 365 and that comes with OneDrive and that's going to be the big one, but maybe we're going to add on Dropbox later. Maybe we're going to add on, a CRM later. Maybe we're going to add on, some other tools that we're going to use. And, generally these tools range from, $150 a month to $200 a month. So let me just aggregate up some potential costs and just say, all right, I think we're going to need to spend an additional $1,000 a month on other tools, right? So
Gotcha.
I would break out the big ones like, AWS or hosting, and some of your other big ones, rent, et cetera, et cetera. But then have something for other that says, all right, this is other things that we think we might need to spend some money on. So we're budgeting for it. We may or may not spend that money.
Right. Right. So generally speaking, it does feel like what you don't want, and what would be problematic for you, I think, as well, is that there's a big surprise, right?
Yeah, absolutely. Absolutely.
And I think the way you described it, I would call it like the wince test, right? Like if you're wincing at paying for something now, it likely means it's a meaningful amount of money that you're doing things to work around it.
Yeah.
But at the same time, you have to think like, why are you raising money, right? Like, is that thing like actually make you more effective? And the reason you're not using it now is because you don't have the money, but the reality is you should use it because it'll make you like significantly better, right? Like, yeah. I would rather list it if you know it's going to be there, right?
Yeah, but there's always things.
It's a bucket. There's always stuff you can't think about. Yeah.
And there's stuff that you may think like, we don't need it today, but we will need it in a year or 6 months.
Right, which is what the good thing about like these kinds of templates is they're basically like saying like, okay, well, here's where you're starting, and so like in 6 months you can start the payment for that thing, right? And sort of get a sense of like so you do have to use the timeline to sort of start to. That's part of what the story is telling, right? Like we're not going to use Dropbox when there's 3 of us, but when there's 10 of us, we will, right?
Exactly.
And stuff like that, right? So using this like timeline, this timeline here is really about staging when you think expenses are going to happen. And I think like, just getting to that level, getting to the granularity of this cost concerns me enough that like, if it concerns you, you should probably put it there, right?
Yeah, absolutely. Absolutely.
The thing I will tell you is, the place you'll get sacked the most is likely from the engineering department. So I recommend you go ask them. Like, engineers are always very optimistic in my experience. Nothing's that expensive and it won't add up to much. And I'm like, yeah, well, what if we're sending 10 million emails a month? I was like, okay, well, yeah, that's money. I'm like, great. Well, that's what I need to know because that's where we're going to be, right? Like, So the sneaky hidden thing is probably on the engineering side or on the services side. So just think about like, and this is where knowing your roadmap or thinking about what your roadmap may be can be helpful because it does play into your sort of the broader growth expectations or capabilities that maybe you're unlocking. I know, for example, like in software businesses, sometimes there's third-party APIs we want to use or services that enrich our data. They're usually expensive, which is why when we don't start using them, but we do want them. And so, that's, for example, just one good place to think about where that stuff would be. So this spreadsheet, like sort of categorizes them. You can make up different categories of expenses. It's good if you have them. I don't think it's necessary. Like usually you could just do this with sections or whatever, but this is the approach they used. I don't think it was like too problematic, but you kind of get the idea. Then they have this other sheet, which is the SG&A, right? Which is basically like, what's it really cost to run your business, right? Like all the other stuff, all in, like, and so this looks at the summary of your payroll, what you spend on marketing, what you're spending on other advisory services, et cetera. Your rent, of course. Insurance, if that's the thing you got to do, utilities, other expenses. And one of the things that they do in this spreadsheet that I thought was cool, but totally like seemed to be confusing and whatnot, was down here. They list out sort of like, I know why it was confusing. They have this payroll section here. Which is basically which goes back to that salaries page. And it basically has everybody listed here again. However, you have to scroll down to get to the head count part where you actually then say how many of those people you're going to have. Right. And so then when I, like, for example, when I make that CEO change, well, now when I go back up to the top, you see now suddenly
now it comes through.
then when I come back further up here, now my payroll is $3,000 a month because of
right. So like, you know, if an investor or an analyst is looking at this, the first thing they're going to say, well, okay, you're going to hire all these people and they're not getting paid anything.
Yeah, exactly. So it's the presence of all this stuff that you're not doing. I think that was maybe the confusing part. But I get it from a template point of view. Like, yes, it's inclusive and it sort of deals with stuff. I like this part though, because at least the headcount part, because what it's doing is sort of giving a feel of like how you expect the team to grow, right?
Yeah.
And so I do think that is valuable, and it also is like for you a tool for you to use to start to figure out like, okay, so when do we need to bring in that salesperson, or when do we bring in that support person? I did some interesting things in mine. Like I looked at how many customers I had, like from the revenue tab, and then I would just increase the number of support people basically based on like how many customers we were seeing, like expected growth, or when you need that head of sales, et cetera. So I didn't do a formula though. I just eyeballed it. I sort of went back and I said like, okay, when this happens, I want to be here. When this happens, I want to be here. But these kinds of things, maybe they're better for us than they are for others, right?
Yeah.
I don't know. But then again, there was a marketing section here where they itemized all the sort of ways that you might spend money. So I guess like, this would be like Facebook or Pinterest or whatever. Then campaigns. So again, a lot of detail, like for us pre-seed, like all of these were just zeros, probably worth it just to all of them because we wouldn't touch them, right? This section I think is valuable, and it's where a lot of people make mistakes or maybe don't have enough experience, and it may be worth putting in a little bit here. But you are going to have to pay for like a lawyer. You're going to have to pay for some accounting. You're going to have two kinds of fees: the one-time stuff, and then you're going to have a bunch of things maybe that are ongoing. I think, what are price ranges? Do you have any insights or thoughts to share just on like if people are funding their pre-seed or maybe based on the vehicle, like?
I think I think for I'm forgetting what the numbers are, but legal expenses generally to raise off of a convertible note or a safe are pretty low. I think
like thousands.
A few thousand. Less than 5K for sure. Possibly, around 2K. Depends on who your lawyer is and all that. But safes and convertible notes are relatively cheaper. A Series A priced round could run you somewhere around 10 to 15K. Right. Again, please don't quote me on these numbers. They're not necessarily the most recent numbers that I've seen. But for early stage companies, it's a couple of $1,000 to close a pre-seed or seed round. It's not going to be 10 to 15K. And I'm sure if you talk to some of your other founder friends and say, hey, which lawyer are you using? You can reach out to a couple of lawyers and just say, hey, how much is it going to cost? Like, there's a couple of lawyers that I know have done full incorporation plus all of the docs that founders require, employment agreements, vesting agreements, et cetera, and usually it's like $1,500 to $2,000 to get that all done in one shot, right? Like you can register a company for like less than $500, but and some of the other documents that are usually cookie cutter and you just fill in the blanks type of thing, where it'll run you about $2,000 to set up a company, right? So that's kind of a range that I would say, all right, like day zero is the day we incorporate the company. We're going to owe lawyers, $2,000. We're going to figure out payroll and set some of that stuff up. Though it may not be day zero, we may set up payroll in day 90 or something, right? Because we're hiring an intern and we got to pay that intern $500 a week or something like that. And so you're going to set up some sort of payroll. You might use like an online platform to do that, or you might use your existing accountant.
Like Gusto or something like that. Yep.
What's that?
Yeah, and those are the kinds of expenses I think like Gusto or something like that, where you should think about, hey, like don't forget those things, right?
Absolutely, absolutely. But what I've in my own research, I found that a lot of times those online platforms are significantly more expensive in the short term than using an accountant, because those platforms assume that you're a company of a certain size. They want your payroll, they want your 401k, they want to handle all your health benefits and all these other things. So they just want to put this big bear hug around you and be a platform for everything. Now, when you're a company, day 15 of your existence, you just don't have the money or have a need for a lot of those things. So it's like, look, it's just too expensive for us to pay for all that today, right? We may switch to that in, a month after we close our round, but we don't necessarily need that today, because the day we close our round, here's 3 people that we've already identified that we want to hire. So we're going to need to set up payroll for those people, and then it starts making sense, right? Like put your 401k, set all that stuff up all in one place. But yeah, I mean, look, it's easy enough to kind of figure out like approximately how much some of these things are going to cost and budget for them.
Yeah, like Gusto, I think it's like $6 a user or something per month, right? Like, it just takes care of the basics. And I agree, like other services definitely want to get more things out of you, but the one thing you probably don't want to screw up is like payroll and unemployment, right? And so like I highly recommend that you don't get that wrong. Like use a service or an account or someone just from the beginning, so that you don't get in trouble with that.
Yes. Those penalties can be pretty severe.
As a cautionary tale, I also kind of like, again, being conservative, I would like pretend you're going to need like about $2,000 per quarter of legal work. If it's fine at the end of the year and you haven't used it, great. You have an extra, like whatever sitting around. But you may get like, as you add employees or as you like start to like, oh, we didn't do a privacy policy, now we need to do that stuff, or GDPR, we didn't do stuff on that. There's going to be these little things that probably and it's useful for you to figure out. Just much like with the other on the software side, there's like an other on the services side, and it would behoove you to not put a little money away for things like that will also come.
Yeah, absolutely, because those are all things that could be unexpected. Because it's all right. So let me rephrase that. They are unexpected because you don't know.
You don't know, not because it's
unknown. Exactly. You don't know what you don't know, right? And if you just say, look, I don't know what kind of legal work I'm going to need or what kind of additional accounting work I'm going to need, but let me talk to a lawyer and an accountant and find out like how much do they charge and how do they charge, right? Do they charge by the hour? Do they charge by the particular type of work that you need done? And just budget in some amount and say, all right, I think I'm going to need to spend a certain amount on some sort of legal services every month, every quarter, and just budget that out, right? And at the end of the day, that's being accounted for in the amount of money that you're raising. If you're not using that money, you can then say, all right, look, we're going to reallocate this money to using for marketing or to use it for hiring an additional person, something like that, right?
Sure.
That's okay.
Yeah. And here's my caution would be this, right? If somebody pushes back on you for these kinds of things, I would be very careful, right? So the reason I say that is that someone should appreciate you being conservative when you're making a long-term plan, right? Yeah. But also should not be trying to kill you, right?
Yeah, absolutely.
Right?
And they shouldn't be trying to micromanage you also.
Absolutely, right? Like, so Now, if someone's like, I don't think you need to spend this much on marketing. Okay, there's a conversation you can have about if that's a wise choice or not. Like, should we blow all of our money in month one on marketing, right?
Yes, and it becomes more important when those are large numbers, right? So if you're saying, hey, I'm budgeting spending $500 a month on additional accounting services, all right, that's $6,000 a year. Not that that's a chump change or irrelevant, but it's like, all right, in the grand scheme of how much money you're trying to raise, it's important to know that you're budgeting $6,000 a year to spend on additional accounting services. But there's no reason for an investor to come back and say, well, why? Why are you budgeting $6,000 for accounting services? It's no, like, there's no reason for the investors to nitpick on that.
You have to be careful if people fight you on, like, if someone has a question, you should answer it.
Yes.
If they fight you on what you believe and they don't have anything except like, I just think you can raise less, so hence you should take some of this money out. That's probably not like the right way to get to the place you need to be, right?
I agree.
And by the way, this line item is not the thing that decides like, should I raise 250 or 500K, right?
Exactly. But if you're saying, hey, I'm going to spend $50,000 the day we officially launch on marketing, all right, that's something that we should discuss and potentially argue, because that's a sizable amount of money on one particular
and you may be right, like there's nothing saying you're wrong, right? Like,
but it should be something that's discussed.
That's worth discussing, right? Like, for sure.
Exactly.
So there's another chart in here, another tab in here that I think is probably one of the ones we talked about. Is sort of this idea of the revenue and how you're going to get to it. Yeah. And I do have some questions in here. So they do. I like their chart, their layout. Again, it's you're sort of the same thing. It's like, what service? It's here's my SaaS, and it's gonna cost the unit price is gonna be $100, and then I'm gonna have 10 of them, with 2 of them this month, right? Or whatever it's gonna be, right? They basically work your way up to figuring out, how much revenue you're gonna make. Now that's cool. I think the hard part in here, though, is actually not like the revenue. It's the month over month revenue, actually, that deserves some consideration.
Yeah, no, I agree. I think
what's the growth rates and these other things? What are some of your experience here? For example, I'll tell you, the typical 1 million ARR, right, basically means getting to the point where we've got, up to 100K or whatever, right? Right. You know what I'm saying? So yeah, I'm just curious. Can you share a little bit about the revenue, like, and just tips on modeling? Because I think that's probably the most important piece, just for people. As I noted early in the abstract, the secret here is to not look like an idiot, like you've never done it before, and so you're just making wild, brash sort of assumptions, right? But also staying within the reason. If you're too conservative, they can say like, great, we should accelerate this. What does it take to do that? You can recover from that. It's harder to recover from the other end when you make stupid statements.
Yeah, absolutely. And look, it always comes back to the investor trying to understand how you're thinking about this, what proof points do you have, and what assumptions have you made, right? And now the investor is going to make a judgment call based on that. If your revenue projections are grounded in safe assumptions, right? Like, so, hey, the industry average for customer acquisition is $1, right? And we think we're going to do it in 25 cents. Well, all right. There's going to be pushback, and there's going to be like, well, how do you think that you can acquire a customer for 25 cents when the industry is 4 times that, right? You need to really explain that, because that's going to directly tie into your revenue model. If you go in and say, look, the industry average is $1, and it's going to cost us $1, and we believe that our lifetime value will be 3 times that. Okay, fine. Industry average might be 2 times that. You think you guys can do 3? Okay, explain to me why, and that will translate through your revenue, and we can say, okay, so now if we spend a little bit more money on customer acquisition, we know based on proof points that you already have that we can actually accelerate this revenue growth just by adding more money into the mix. But if your assumptions are not grounded in reality, it's going to raise a lot of questions, and people are going to say, well, I don't really believe that this is the case. I don't believe that this is true, or I don't think you guys can do it more efficiently than the industry does, right? And that's going to affect your revenue numbers. Once you get those assumptions and projections somewhat conservative and realistic, I think what people want to see is when you're starting off with a small base, people want to see large percentage of growth, right? So if you're starting off of $1, getting to $2 is only 100% growth, right? But getting from 1 to 10 is 10x growth, right? So in the first couple of months, people want to see large percentage of growth, and people understand that over time that's going to taper off. The absolute numbers are going to keep growing, but the percentage of growth is going to eventually slow down, right? And that's normal. That's the sign of a company or a business or an industry maturing.
And then 100%, do you think about that month over month or annualized?
Well, I think different people look at it different ways, right? And I think you want to look at it month over month, and you want to look at annualized also. Because I want to know, like, hey, if you suddenly, and this is more about actual financials than it is projections or actual metrics, if I am seeing that you are growing faster than anticipated, I want to know why. I want to know, like, all right, what did you guys figure out that has caused this? Or do you even know what you did that caused this, right? Is it something that, hey, was out of your control and things just took off, or have you done something, right? And if you have done something, what have you done? Let's identify that, and can we do more of it, right? So now you're building momentum behind that, right? And that momentum could mean a sustained percentage of growth, right? Rather than growth rates tapering off and absolute numbers continuing to increase, you're sustaining that growth rate and your absolute numbers are increasing much faster, right? Which is hard to do as a business matures. But that's what people want to see, is like, all right, have you figured this out in a way where it's making sense and you can actually grow at that sustained growth rate, or even a faster growth rate, by spending more and doing something that you've already figured out?
Right. Yeah. Yeah. So I guess it's okay to be aggressive early on, but
or you should be aggressive.
Yes. But try to set up
grounded in reality.
That's right. Like the ceiling should be set by use an existing thing that you can to place as the ceiling, right?
People like to see comps, right? Because they can put, and investing in startups, and people talk about this all the time, is pattern matching, identifying patterns and continuously matching those patterns that have worked. So if use that to your advantage, say, hey, this is what high growth businesses have done. These are the numbers, they're public, and we're just using those exact same numbers. If they could do it, there's no reason we can't do it, because we're in the same industry, but we're not competing with them. Or whatever, right? Like, but use that to your advantage.
Yeah, makes sense. And in the earlier phase, it seems like not worrying about churn and any of these other things really seem so relevant per se. There's going to be churn. Even the acquisition cost is a thing that over time you try to manage. It tends to increase over time. As you get more penetration in the market, reaching like the nooks and crannies, right? Like it does become more expensive. So those things are going to go up. But like, I don't even know, like, I don't usually see, CAC seems to be computed, not like typed in, right? So the number one contributor after basically all your fixed costs is marketing, right?
Absolutely.
Or commissions and sales and whatnot, right? Like, so those are your wild cards, but like your team, your office, everything it takes to be open every day is the fundamental part of the costs. All right. Well, this has been good. I hope everyone out there has gotten to see like that the financials are daunting. At least I'll say so. Like, as someone who doesn't do this crap all day.
I just want to add,
right?
Like, it's not necessarily a bad idea to ask another founder for help that's gone through the process.
Yeah.
It's also not a bad idea to, if you have a friend who is an analyst at a VC firm, ask them for help or template or something and say, hey, could you give my numbers a once over, and what do you think? This is a team sport. It's not a solo sport. Go out and build out your team and say, hey, this is where I'm at. This is the assumptions I've made. This is what I've done. Am I crazy? Does this make sense? And you're gonna get different opinions, right? Like one person might look at something and say, yeah, it makes sense, and I get it. And somebody else might look and say, well, I don't know what this is. This makes no sense to me, because people coming at it from different lenses, right? And people are coming at it from different experiences, and that could change their perspective. So it's good to get a couple of different perspectives and say, all right, what's my lowest common denominator? If 2 out of 3 people are coming to me, or 2 out of 5 people are coming to me and saying they don't understand, something's wrong with what I put together, and I should go back to the drawing board and fix that. So that at least 4 out of 5 people understand. Maybe 1 out of 5 has a question about how I'm doing this or why I'm doing it a certain way, which is okay.
Yeah, and like people will have different experiences in each of these different parts that we showed you today. So some folks will be like, oh, I got bit by this, and your business is a lot like mine. I bet you hadn't planned on this, but you're going to need to pay this, or you're going to need this insurance that you didn't actually list out because, you do this kind of work, and guess what? It actually is covered by this thing. Or I guarantee you, one of your customers, as soon as you get one, is going to ask for this, and so you're going to need to have all this other stuff done. So yeah, I agree. Really good point. That is very important for you to rely on your network, rely on folks who've been through it, rely on folks just with more experience as a general rule, to help you get a better sense of what's next.
And if you don't have somebody in your network that can help you with that, find somebody who's an advisor and pay them to do it. Right?
Yeah, and there are lots of people out there like that. If you are interested in meeting anyone like that, let us know. We will connect you up. Speaking of which, the next I think when I do that you can't hear me. So in the next episode, yes, our next episode is episode 110. We will be going over who to raise from and how to reach out. Which really, I think, once you've got all these bits and pieces in place, is sort of when you finally arrived at this this part of the process. So we're trying to figure out our schedule for next week. We will hopefully do it next week. If we can't, we'll give you an update. But just keep an eye on foundercraft.com to get the latest info and the updates on where to go next. Pankaj, it's always a pleasure. Thanks for joining today. And I like the new digs there.
Yes, it's a beautiful place.
Maybe we'll see you in an even more exotic place next time.
Next time, I think so.
All right.
I think so. That just might happen.
Yeah. All right.
All right. Thank you, everyone, for joining us. We'll see you again next time.
Yeah. If you've got questions, hit us up in the comments. Bye-bye.